Welcome to the Hurst Trading Room. This is our video update for the 17th of December 2012. As always, please make sure that you have read and understood these disclaimers before we move on and take a look at the markets. Let's take a look first of all at the S&P 500. Now, last week, as you know, I spoke about the fact that we had entered a long C category trading opportunity, which we had done the week before, and that turned out to be a profitable trading opportunity. As you can see, our T1 target was hit on the Tuesday of last week, and our T2 target was also hit on Tuesday of last week. So we took our profits all in a single day on Tuesday, and at that point, of course, we also raised our stop loss on our remaining open trade 3 and started applying the 3-bar trailing stop. The market went up a little bit higher on Wednesday, then came down again, and on Friday our 3-bar trailing stop kicked in at a level just slightly above our entry price, and so we took a really small profit from our trade 3, something like $11. But all 3 of our trades in the S&P 500 were profitable trades for our C category trading opportunity. And there we are. So we've had a good run in the S&P 500 with our profitable A category trading opportunity, which we entered in the third week of November, and our C category trading opportunity, which of course we entered just over a week ago, and that was all over. These 2 trades are really representative of the sort of character that you expect from category A and category C trades. Category A lasts longer. Category C is often much quicker. But they were both profitable trading opportunities, and so our next trading opportunity in the S&P 500 is for a short category D trade when price crosses down below the 20-day FLD. So that would be a D category short trade. Now, of course, this is the December future. The December future in the S&P 500 expires this week. On the 19th of November, in fact, on Wednesday. And so our next trade will be in the March contract. So, of course, I have created a chart in the S&P 500 as explained in Module 3 for our future for the March contract. And take a look at the detailed video about the S&P 500. You'll see I'm plotting a VTL on the March chart, and that's because that VTL is providing us with evidence that the peak in the 40-day cycle has occurred, which corroborates the fact that we should be taking a short trade next. And so that's what's coming up next for the S&P 500. In the Nasdaq, we have a similar situation, because, of course, last week I spoke about entering into the C category long trading opportunity, and we were using the 10-day FLD, which came down through the price action on Monday. Of course, we didn't enter the trade because of our rules for Monday trading. That price cross occurred within the range of Friday's bar, which was quite a big range bar over there. And so we didn't enter that long trade on the Monday, but on the Tuesday we entered at the level of Monday's high over there. So we entered there, and that also proved to be a very profitable trading opportunity. Here was our initial stop loss down here. And so our trade 1 and our trade 2 targets were both hit on the Monday. On the Tuesday, on the day of entry. So we exited from both of those trades, and our stop loss for our remaining trade 3, which was still open, was struck on Thursday, and so we exited trade 3 at a break-even level. So we didn't make or lose any money on our trade 3, but we made money on our trade 1 and our trade 2. Here again, you can see the character of these trades. Here was our profitable A category trading opportunity that we took towards the end of November. It was a long trade, as you can see. It lasted for quite a long time. Our C category trading opportunities always much quicker. In the Nasdaq, it was of a total duration of only about 2 days. and it was all over. As mentioned in last week's video, it was too late to enter a short category D trade, and it is still too late to enter a short category D trade in the Nasdaq, and so that is an opportunity that we will have to pass on, because it isn't available to us, because price is below the level of the FLD. It is just possible, of course, that price is still simply tracking along that FLD, and the price is going to come up and give us the opportunity to get into the short category D trade. But as there have been 30 bars, as you can see over here, since the most recent 20-week cycle trough, it is more likely that a 40-day cycle trough is going to form fairly soon, after which we will enter a long E category trade in the Nasdaq. So we're watching the level, of course, of the 20-day FLD, and we are standing by to enter into a long E category trading opportunity in the Nasdaq. I'm not jumping at that opportunity because of the fact that the S&P 500 still has a bit of a move to go to the downside, and it is still slightly early days, so I'm not going to jump in immediately. It is possible that price is still sort of attracted to that FLD and is still fiddling around at the level of the FLD, so I would expect a little bit of a clearer break for the entry into the E category trade. So I'm not jumping in, but I'm certainly standing by and looking out for that opportunity. Now, the next instrument is the euro to US dollar. The euro to US dollar has been going through a very interesting price movement and FLD interaction, and one of the things that's made it really complicated is the fact that this trough over here occurred 24 days after this 20-week trough over here in the middle of November. As you know, this is now my preferred analysis. We did initially consider this to be a trough of only 40-day magnitude, but I now believe it is a trough of 20-week magnitude, and I discussed that in further detail in the detailed video about the euro to US dollar. And last week, as you know, we had entered a short D category trade on the Friday of the previous week. And in the detailed video this week, I explained the two reasons why we reversed this week into a long, either an E category trade or what is called a D reversal or C category trade. And I explain that in detail in the detailed video about the euro to US dollar. But as you can see, on Wednesday of last week, we exited from our short D category trade for a loss. It wasn't, of course, the full loss that we were expecting to take. That was our initial stop loss for the D category short trade, but it was a much smaller loss than that, but it was nevertheless a loss on all three of those trades. And we reversed our position on Wednesday into a long C category trade or possibly an E category trade. And take a look at the detailed video for a discussion about that in terms of which trade we're actually in now. It doesn't really matter which trade we're in because it is, of course, a long trade, so it doesn't really matter whether it's E category or C category. Our T1 target was hit on Friday. For that trade. There we go. So we made some money from that. And our T2 target was hit earlier today. There it is. T2 target over there. And as a result, we have raised our stop loss to the level of entry. So we're now at a break-even stop loss on our trade 3. And so that's our current situation in the euro to US dollar. What's going to happen next in the euro to US dollar? Well, I am standing by to enter a short trade in the euro to US dollar when it crosses below the 20-day FLD. It will either be a D category short trade if we are currently in a C category long trade, or it will be an F category trade if, in fact, the 40-day cycle trough has occurred over there. And there's a question mark around that. That might be the 20-day cycle trough as indicated in this analysis, or it might be the 40-day cycle trough. Take a look at the detailed video for a discussion about that. Nevertheless, we are standing by to enter a short trade next once this current long trade finishes playing out. And so it's short next for the euro to US dollar. Let's take a look at the British pound to US dollar. The British pound has also been going entirely our way, as you can see. We of course entered a very profitable A category trading opportunity towards the end of November, exited there and there, T1 and T2 in a single day, and exited finally because of the 3-bar trailing stop about 10 days ago from that trading opportunity. Last week, as discussed, I was standing by to enter a C category trading opportunity at the level of the 10-day FLD, and on Tuesday the 10-day FLD was crossed. Of course, by that time the 10-day FLD was within the price range of the previous bar's trading, so we entered at the level of Monday's high, which was this level over here, and our T1 was hit the very next day on Wednesday. So there's T1, and our T2 was hit earlier today. It was somewhere up here. So T2 was hit earlier today, and so again here our stop loss in the British pound to US dollar has been raised from the level of the initial stop loss, that was it down there, has been raised up to the level of a break-even stop loss. So no matter what happens in the British pound to US dollar, we are walking away from this trading opportunity with some good profit. And what's going to happen next in the British pound to US dollar? Well, there isn't really any ambiguity. What's happening next is we are going to enter a D category short trade as price crosses back down below the 20-day FLD. So a similar situation to the situation that we are seeing in all of our other markets, which is of course why I like to analyze closely correlated markets, because as long as everything looks as if though the same thing or the right thing is happening, then you have a good indication that what you're doing is correct. You're seeing slightly different analyses but coming up with the same end trading result, which is what's important. So that's what's coming next in the British pound to US dollar, and so of course those trades are all set up in the spreadsheet. Let's take a quick look at that spreadsheet. Right, here's the spreadsheet, and as you know, I like to color the background rows according to the status of the trade, and these orange background color rows are trading opportunities that are still active but the trades are closed, and the blue background indicates a trade that is still open. So here is the position in the euro to US dollar. As you can see, it's making a profit of $450, and trade 3 will at worst case break even, so it won't lose any money. Of course, as the price action unfolds, it might make some money. And the situation in the British pound to US dollar is in fact exactly the same, $450 profit that has been taken, and trade 3 is also at a break-even level. That's the worst that could happen to it. Why is the profit in the euro to the US dollar the same as the profit that we took in the British pound to US dollar? Very simply because our position sizing is controlled according to the risk that we're taking. And so we're taking the same amount of risk in both of those instruments, and that's why the profit that we made out of trade 1 and trade 2 is exactly equal. All right, let's take a look at the NASDAQ trade. Now that C trading opportunity looked very insignificant on the chart. As you know, we were looking at it a moment ago, it looked very insignificant, but in fact C category trades are usually very profitable, and it turned out to be the case in the NASDAQ. We made $510 from the trade 1 and trade 2, as you can see, $150 and $360. Trade 3 exited at a break-even level, so we made no money out of that. The S&P 500 over here, you can see we made $611. Okay, so that was good. Also a very profitable trade 3 C category trading opportunity. As a matter of interest, the short trade, the losing trade in the euro to US dollar, over here you can see I've drawn over it a little bit, but each one of those 3 trades exited for a loss of $134. So I guess altogether that was a total loss of $400 minus. So even though our D category trading opportunity short trade in the euro to US dollar was a mistake, in total we lost $400, and in fact we've already more than made that up in the euro to US dollar itself, and of course in the other instruments that we've been trading. So that losing trading opportunity wasn't much of a disaster at all. Please be aware that the futures contracts, for most of the futures that I'm trading certainly, expire this week. I'm often asked how one should handle rollovers. The situation is this: if you're in an open trade, then it depends on what kind of a trade it is. If it's a trade that you expect the profits to run, and there aren't very many of those, that's an A category trade and an H category trade and possibly an F category trade, then I would consider rolling over, in other words taking my trade and rolling it over into the next contract. If it's any of the other trading opportunities, such as a C category trading opportunity, D, E, then I wouldn't roll it over. I would simply close out the position at a profit. Presumably your trades are in a profit if you're still, or if you're considering rolling them over. So I would exit from those trading opportunities and start looking for the next trading opportunity in the next contract. Okay, you must bear in mind the average duration of our trades, which is not very long. The average duration of our trades, as you know, is of a week or less. The trade threes can sometimes run to 2 or 3 weeks, but the average duration is fairly short. So it's usually not worth rolling a trade over. So you should exit any open trades you have if you have a futures contract that is expiring this week, and look at your next trading opportunity. Don't try to get back into the same trading opportunity. That's my advice. So that concludes the summary for today, the 17th of December. Please take a look, if you have time, at the detailed videos in each one of the 4 instruments so that you can understand in more detail the trading decisions that I've been making. As always, if you have any questions, put them into the comments. I wish you, as always, profitable trading, and I will see you later in this week or next week.